Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, and we're up to number 95, part 4 of our little series here on buying an investment property. There's the usual disclaimer: facts and figures, information only, not advice in today's video. Okay, our investment property, it's an investment. We're trying to make money, and we're trying to work out what it's going to generate for us over the time we've got it. And so we need to take into account any vacancy rates. And we do need to expect to have vacancy rates. Now, you might be very lucky in having a tenant, a long-term tenant that's been there for year after year after year, but of course they can still move on, pass away, and so forth. So we do need to take that into account. And of course the bank will certainly take it into account when they're organising your loan. They will not assume that your property is indeed rented out for 52 weeks a year. So we need to take these vacancy rates in when we're trying to work out what is our actual net yield. We need to build in a bit of a buffer. Banks tend to look at sort of 4 to 6 weeks of being untenanted, and that's probably quite realistic in many cases. But as I say, if you've got a long-term tenant, then it may not be something you need to worry about. Probably just depends on the property and location and so forth. But if you do find yourself in a situation where your property, you do not have a tenant, then I would strongly suggest that you might be better off to actually drop the rent if you're struggling to get a tenant than having it untenanted for week after week after week. Having a drop of 5% or so, it doesn't take too many weeks of no money coming in to make up for a reduction, say, of 5% or something similar. So better to get something rather than nothing. But obviously, just again, depends on the property, depends on the location and the scenario at the time. So the money coming in, does it actually cover our expenses? We hear about this thing called negative gearing, and people get all excited about it. I had a gentleman who had 12 properties in northern Canberra here. Every single one of his properties was negatively geared, meaning that the rent does not cover expenses. He's losing money on 12 properties. Now, quite frankly, I don't really see the sense in that, because you get to the point where he's got fantastic tax deductions, yes, but it's effectively costing him money. It's coming out of his back pocket. His normal cash flow is being impinged by the fact that he hasn't got this money coming in from rent. So the rent doesn't cover all the expenses, and you've got to dig into your own money. People get excited by negative gearing. Do I like negative gearing? No, not particularly. If you give me a choice, I'd rather have this positively geared property, and that's where your rent exceeds all the expenses. So your property is paying for everything, and there's even money left over. And we can take the money that's left over to either enjoy or take that money to invest in other things to make us even more money. So a neutrally geared property is basically where it's just even Stevens and the rent equals all the expenses and there is no surplus. That's not a bad place to get to, so that your property is just paying for itself. So the rent is covering all the costs. And of course, therefore, if the property is going up in value, yes, indeed, we are indeed still making money, even though it might only be neutrally geared, because we're making money from the capital growth. Remembering, of course, that capital growth you can't access until such time as you actually sell the property. And then, of course, there's capital gains expenses. But don't get too excited by this negatively geared thing. Your tax deductions are the same, effectively. Your tax deductions remain the same, whether you're negative, neutral or positive. It just means that after all the tax deductions are taken into account, how much money is left over. It's not like you're getting bigger tax deductions. Yeah, it just means that once you get into positively geared territory, yes, you have to start to pay tax on that positive money. Is that a big problem? No, I don't mind paying tax because it means I'm making more money. And then, of course, we just look for other ways to reduce our tax liability. Could be a case that extra rent that we're getting, we can then put into super as a concessional contribution perhaps and get a tax deduction that way. So we just got to think of our overall situation there. So let's look at a bit of an example here. And we've got a property where we've got a $500,000 mortgage. So we've got a $500,000 mortgage, pretty much borrowed the lot. And when I did the slide, interest rates at that stage, you could get an investment loan about 5%. You're probably pushing closer to 6 and 7s at the moment. You're in April of 2024. So if we assume then a rental income there of about $26,000, this is like our 5% return there, then effectively what we've got is $26,000 a year coming in from rental income, $500 a week in rent. Our loan repayments on this $500,000, $35,048 a year, $35,000 a year, yes, that's what it's going to cost you at 5% if you're paying the principal down, $25,000 there if you're doing as an interest only, say over 5 years. So yeah, $10,000 a year difference in mortgage repayments by doing a principal and interest compared to an interest only. So you can see why people do interest only, but of course you are not actually, the equity is only increasing by the capital growth. It's not increasing because you're paying your debt down. We've got a rental manager, and we're assuming they're reasonably conservative, 7% of the rent. So the rental manager is getting $18.20. A body corporate for, say, let's assume this is a 2-bedroom unit, $2,500. Yep, probably cheap compared to a lot of body corporates that people are paying on their rental properties. In Canberra, there's land taxes. You might have to do some sort of insurances there. Extra accountancy fee. I think I'm being pretty conservative, for your accountant to only charge you $300 to look after a rental property. I would assume, generally speaking, it'd be more than that. But as I say, I just want to give you sort of an idea. We're not being excessive with our expenses, but these are just normal expenses. Now, rates, depending on how the rates maybe include the body corporate, in which case the body corporate may be higher. The rates might be separate. Certainly there'd be some form of maintenance you would expect. We're assuming there, yep, a bit of a vacancy rate. Now that may or may not be the case. $2,000 difference in income there if it was fully rented for the whole time. But a total there of $45,000. Now we've got $45,000 of expenses, $26,000 of income. We are down the gurgler by $19,500. This is this investment that's supposed to be making us money, but we are indeed nearly losing $20,000 a year to maintain it. So has our house gone up by $20,000? This is the bit that people don't seem to sort of take into account. Now, yes, we get a tax deduction on that because it depends on your marginal tax rate as to the value of the tax deduction. But we still basically had to find this money. So we're basically topping this up with a $749 a fortnight top-up. Now, of course, if we're doing interest only, it's sort of effectively half that, $367 a fortnight. We still have to find, and yes, with the tax deductions, we could be getting close to making this thing, getting close to neutrally geared. But when you look at the amount of money that is indeed paying into this thing, that's money that has to be made up. And investment's got to make us money. So the capital growth and the tax deductions need to be making us more than what we're losing over time there. So, I think I'm being conservative with some of those numbers. But if you're going to get into this, find out what your insurance is going to be, your rental manager, body corporates and so forth. Talk to your accountant, what's he going to charge you? And do some numbers to really figure out, do you have this money? Now, you can get a tax deduction, but generally speaking, you're not going to get that back until tax time. Can you afford to find $750 a fortnight out of your normal day-to-day to make all this work? So, now, of course, as time goes by, the value of the property should increase, giving you the gain. But of course, you go along to these property seminars and the property developers are suggesting that house prices go up by 7 to 10% each year. Now, of course, we know that's not true. Sometimes house prices go up by 20%, but they also don't go up for years. I remember periods in Tasmania, where I'm from originally, that house prices basically didn't move for nearly 15 to 20 years there, back in the 80s, 90s or whatever it was. So it may average out, or may have averaged out over the last decade or so. What's it going to do over the next decade or so is the far more important question. But don't assume that your house is going to go up 7 to 10% every year. That is not going to happen. House prices seem to surge, and then they plateau and remain stagnant for a while. Then they might have another surge. There may even be a pullback, and there could be a serious pullback if these interest rate issues become more of a problem. But in theory, as your price goes up, the rent should go up, and of course, therefore, our negatively geared property should become neutrally geared at some point, and then moving on to positively geared at some point. That's the theory. So, but we just need to compare our cash flow with the inflation rate, the cash rate. How much are we really making in real terms? That's what it comes down to. Does this investment make sense? And if it's not making sense right now, will it make sense in the shorter to longer term, depending on what's going on with the markets? So now, of course, if we are making money, we finally got to a positive geared property, and we're sitting there, the house price is going up, the rents are going up, the income's covering all the expenses. What are we going to do with it? And of course, that's where a lot of our other sessions are coming into play here. Happy to talk about it, and look forward to joining you for the next part in this series.